You don't see a tech stock crash here, do you?
There are two ways to answer your question. First, if you look at broad indices, just taking into account the impact of interest rates. You know, we're talking about valuations being expensive, that's right, but it really depends how you discount them. If you discount longer-term valuations, you know, by the long-term growth rate of the US economy, it looks as though, if you look at the S&P, for instance, stocks are overvalued by around 40%. Now, if you use current interest rates, which are really low, in fact, in terms of overvaluation, you're just back to 4%. You know, so that just to give you a macro picture on the fact that valuations today, with rates being so low, it doesn't mean much. Now, if we move specifically to the tech question, you're right, there are some outliers which indeed look very rich. But if you take a broader picture, in fact, you do have those trends towards digitalization, which I think will really remain with us. So that's a positive. If you look at earnings growth, in fact, it's quite supportive. And most of all, I think these are corporate. When you look at their balance sheet structure, compared to other segments of the markets, these are corporates which have a very sound, very robust balance sheet structure with a lot of cash sitting on it. And that does make a difference in an environment where debt ratios across the corporate world are rising, and where I think going into winter and autumn, we are going to see default rates rise.